In 2023, we had a near miss with a banking crisis that began with a bank run on Silicon Valley Bank, which then spread to other banks, reaching as far as Switzerland with the collapse of Credit Suisse. But is it a near miss? In fact, the banking crisis is still underway, and we may just be in Act 1. Before we get started, please take a moment to like and subscribe to support the channel. Thank you. For those of you who don't remember or did not follow the news closely, there was a major banking crisis in March of 2023. We had several bank runs and banks went into receivership with the FDIC. There were fears of global contagion, and Credit Suisse failed a couple weeks after Silicon Valley Bank's initial failure, which was a massive collapse. Now, Credit Suisse was bought by UBS, averting an immediate crisis. The issues with the banking sector were calmed down after swift action by Congress. Banks were given monetary support through the Bank Term Funding Program, or BTFP for short. But even though crisis was largely averted, there was a considerable amount of panic in markets and by the ultra-wealthy, whose deposits were not fully insured by the FDIC. Now, the FDIC only insures the money in your bank by up to $250,000, and if you have considerably more wealth than that, 250 large may not go very far. Now, the precious metal industry saw a surge in demand unlike anything we've seen in the past 20 years. Longtime customers at APMEX who were shopping with us for a few months after the first bank run may recall just how busy we were. The demand for gold and silver was just unreal, and the ultra-wealthy were parking their dollars in gold in particular. Although we could say the issues were calmed down, it may be more appropriate to think of the banks as having been given a band-aid to cover a larger wound. Our viewers may think back to the 2008 financial crisis and recall that it generally takes more than a couple of weeks for a banking crisis to resolve. And make no mistake, this was a crisis. The global financial crisis in 2008 heralded the failure of hundreds of banks. When the dust settled, over 400 had failed over the course of years. And in 2023, at the time of preparing this video, only 5 have failed, which helps to downplay the crisis a little. But the assets under management from the banks that have failed in 2023 are greater than the 2008 financial crisis. So fewer banks have failed, but with more money at risk. So the magnitude is there. There are good reasons to presume that the crisis is not quite over yet, though we hope it is being actively managed. Now consider in 2008, Bear Stearns failed in March and Lehman Brothers did not collapse until September. Regulators had months to respond to the initial warning signs and the chance to act to prevent a serious crisis from unfolding. You see where that led? Let's take a moment to cover the risks the banking sector is facing. We have rampant inflation coupled with massive and unprecedented rate hikes from the Federal Reserve under Jerome Powell. We have serious stressors in the commercial real estate sector, which is built on loans from banks, a lackadaisical attitude believing that the worst is behind us, and we are continuing to see bank failures straggle in, though they're not being reported widely in the news. In July, a small bank failed, and on November 3rd, another bank failed. While these were smaller banks, let's put this into context. In 2023, we've had 5 US banks fail. 2022, 0. 2021, 0. In 2020, we had 4 bank failures. We've had more bank failures in 2023 than we did the year COVID brought the world to a halt. Now, a few concerned analysts have raised some red flags. The primary debt instrument of the United States are treasury bills. Good old T-bills, almost as reliable as Old Faithful itself. But the latest auctions have not been very pretty. They're falling somewhere between the dot-com bomb and the 2008 financial crisis in terms of performance. It's a basic supply and demand problem. China and Japan aren't buying US debt. China, probably because of ongoing geopolitical tensions with the US, as well as a stated intention to de-dollarize. It could be behind some of it. China's purchasing US debt coming to a halt right as the US is issuing trillions of dollars to pay for expansive government programs pushes the value down and the yield up. Fed's also not buying treasuries as it continues to tighten, which would support the overall market. So what does this have to do with banks? Well, Banks have traditionally been big buyers of US debt as well. But if you think Jerome Powell is going to keep raising rates, which increases the yield and lowers the value of the bond, why would you be inclined to take on more treasury bills? It's a bad move. Whenever the yield rises on a T-bill, the value of the existing bonds will fall. So Bank of America, for example, has correctly offloaded half of its treasuries in 2023. If you're a bank who's been loading up on treasury bills, you're probably sitting on paper losses that have yet to be realized. While the market is currently pricing in rate cuts for 2024, remember that we're talking about actions taken in 2023. So what happens to a bank when they have a lot of unrealized losses? People go to the bank to withdraw their funds. Well, that's what starts a bank run. The BTFP, remember we talked about that earlier, was initiated in March of 2023 to provide short-term relief to banks. That fund is being used more heavily today by roughly double than when it was launched back in March and banks were creaking under the pressure of depositor flight. That program is supposed to end in March 24. If that ends, we should expect to see further issues in the banking sector. And to cap it off, it was recently announced that Jamie Dimon, CEO of JP Morgan Chase and one of the financial titans of the world, will be selling about $140 million worth of his bank's stock. Now, some of you may feel this isn't particularly newsworthy. CEOs liquidate all the time, right? At some point they have to cash out. Well, it's sort of true, but what most financially savvy executives do is they take out loans with their stock as collateral, and Jamie Dimon is very financially savvy. This allows them to avoid the biggest expense of their lives, taxes. When you cash out your stock, you pay tax. When you take out a loan, you don't. So Jamie Dimon's willing to take an 8-figure hit in taxes to secure some wealth outside of the system. That's not something you would do if you were confident that your bank stock would be performing very well into the future. Dimon selling stock follows his remarks that we quote, "This may be the most dangerous time the world has seen in decades." We have a combination of factors that give us pause and consider the banking crisis may resume in the near future. We have historical precedent for banking crises to continue for months and years before a resolution or even a peak is reached. We saw a short-term program initiated by the Federal Reserve and Congress to stave off economic disaster, but it did not solve the underlying issues. It merely opened liquidity to banks to prevent more bank runs and calm the market. That program is set to end in March 2024, and we hope the banks are positioning themselves well in preparation. We have multiple stressors on banks today, including the damage caused by rising interest rates, a treasury bear market, ongoing stresses in the commercial real estate sector, and banks are continuing to crack and fail. Cherry on top, we've got Jamie Dimon partially exiting the market as the cracks are widening and the risks are becoming apparent. Now, for those of us holding gold and silver, we're currently well insured against the worst case scenario. And in the event that future bank runs or collapses occur, we would expect a near simultaneous gold rush as people move to protect their wealth. Now, prior to the bank run, we saw gold trading under $18.50 an ounce. Within 2 weeks of Silicon Valley Bank's collapse, gold was trading near $2,000 an ounce and went above $2,000 an ounce in April and stayed there for a while before the market cooled back down. And silver did something similar. Silver was trading around $20 to $21 an ounce, and in mid-April, it was over $25 an ounce. Platinum did not move as sharply or as clearly as the other two did in response, but it still rose as well. Platinum was trading under $1,000 an ounce, and by mid-April, it was trading over $1,100 per ounce and cooled around the same time as our other metals did. That's all we have for you today. Please remember to like, subscribe, share with a friend. Thanks for watching, and we'll see you next time.